Okay, so the goal tonight is to present you this platform, Trade AI, which is, we can say, a package of different sections, each dedicated to a specific function. Tonight, my goal is to introduce you to two of these main sections of the platform. The first is the earnings trade signals, and the second one is the options stream report. And then we will have another live seminar next week, if I'm not mistaken. So you will have the chance to see also another couple sections of the platform. Somebody is probably asking something. Somebody raised the hand.
I don't see any questions for the moment.
No, me neither, but I can see that somebody raised his hand. Anyway, yeah, maybe questions coming.
Okay, I see now, Domenico. They are asking if you can give us a small presentation of yourself before to start.
Yeah, sure. Sorry. Okay. Hi, hi everyone. I'm Domenico Dall'Olio. I'm an option trader. I started trading back by the end of the 90s. I'm an option trader, and I've been a discretionary trader for many years, and finally in 2015 I started studying systematic option trading strategies, and in 2017 I had the chance to meet Vladimir Furman, who is with us tonight, the creator of the platform Trade AI, and we started working together. I have the luck to meet him in Bologna, because he is fond of Italy, and he spends almost all his summer holidays in Italy. He's been doing it for several years, and this year will be the same. He will be in Italy for a couple of weeks. And we had the chance to meet in Bologna back in 2017. We decided to start working together, and here we are tonight. So this is basically it. I'm also a professor at some major Italian universities. I had the luck to have the chance to, to bring my experience in the field in the rooms of the university, because I had the luck to teach in Venice at Ca' Foscari, and the director of the course of study I took a course within it. He gave me full power to bring to my classes the trading platforms and the trading strategies and the options. Of course, I had to be very cautious, not trying to let the students think that doing this job is easy, that it's easy to make money in the financial markets. But I had a lot of fun, because I had the chance to bring trading games into the courses and the like. So I'm a professor, but I'm also a trader. So I know both the worlds of the world of the theory and the world of the practice. I've been doing this for many years so far. You can see from my white hair that I have quite an experience in the field. Anyway, out of jokes, what is the Trade AI platform? As I already told you, it's a package of services, and basically we can say it's a screener. It's a screener that allows you to scan the markets in real time, basically just stock options and ETF options on the US markets, which, by the way, includes more than 5,000 underlyings, so there's plenty of choices to take every day. And the platform scans the market in real time. You just have to refresh it, and it will update all the analysis anytime you want. And it provides suggestions for trades you could take in the options field on the basis of several different probabilistic models, which were basically invented by Vladimir. And I will explain the logics, the philosophy behind the platform in this in this half an hour, 45 minutes we have tonight, and also again in the next live seminar next week. Let's start with the earnings trade signal sections. which allows you to ask the platform to provide you with the best possible trading signals on stocks that are about to release earnings. As you might know, when companies are about to release earnings, volatility increases significantly, and this provides better trading opportunities. Unfortunately, also, there comes a higher degree of risk, a higher level of risk. So you need the tools to, to inspect the markets, looking for the best opportunities you might find. So the idea basically is to select a type of strategy you are willing to look for, and a minimum success rate you are willing to get. Later, I will explain you what the success rate is, what it is based on. Okay, so far, let's just take for granted that we are looking for strategies having, I don't know, at least a 90% success rate, and we want to focus on put credit spreads, just to say. Here you have a list, a short list of potential trades you might be willing to inspect in more details in order to try and understand whether, aside of what the platform is suggesting, what the platform is telling you, you might be wanting to get into more details and try and understand whether it could be reasonable to put them at market or not. We have a symbol, we have a quick description of the company information. The last stock price, you see data are updated in real time. The last update is 2:05 this afternoon on the American market today, June the 20th. Nike is going to release earnings on the 27th of this month. And here we have an icon. If you click it, you have the earnings overview report, which tells you what it's the typical behavior of the stock, Nike in this case, the day after the release of the earnings announcement. Generally, it's the next day if the announcement takes place after the market close, or the same day if the earnings announcement takes place before the market open. Anyway, over the last 20 quarters, more or less, these has been the percentage change in the price of the stock after the announcement. So what was the expected earning per share? This is the consensus of the analysts. What was the real value announced? What was the degree of surprise? The price change, the volume change, and the earning period. This tells you what could be basically the range in the price of the stock after the announcement of the earnings. Then we have the suggested trade, which is in this case is short put 89. It's a put credit spread, so it's short put 89, long put 84, expiration June the 28th, with an expected credit of 0.72, and consider that the credit is calculated hitting the bid where you sell and ask where you buy. So it's a precautionary measurement of the expected profit of the trade. The success rate, 95%, and the expected profit and loss, which is the weighted average of the profit using the success rate as weight, minus the potential loss weighted on 1 minus the success rate. Okay, so it's a weighted average of the expectation of profits and losses using the probability as weights. What is the success rate and how it is calculated? It's an average of 10 different probabilistic models used by the platform to give you a multi-level approach to the problem. The idea is not to have a model. This is to properly explain the philosophy behind the platform. Every model is always, by definition, an approximation of reality. So you can't find the perfect model. It doesn't exist. So what you need is not to try and find the best model available, but if you have the chance to have it, to have multiple models giving you basically the same interpretation of the same phenomenon. When you have 10 different readings telling you more or less the same thing, then you can rely more on those probabilistic readings than in choosing a model which you decide on your own you can rely the most. and you have a model telling you 90, a model telling you 60, a model telling you 40, and another model telling you 100. Okay, that's not good. When you have all the models telling you so much different readings, you have a problem, because you cannot decide on your own which model to rely on. It is much better when you have many different models telling you basically the same thing. So what are these probabilistic models? Let's start with the first, the normal distribution. You know, it's based on the hypothesis that the returns are distributed normally. And as I will show you in a while, the chart of the expected distribution of returns based on the normal distribution is centered on the last available price, 95.97 in this case, and the standard deviation is the implied volatility of ATM options, at the money options. So the distribution of the returns based on the normal distribution is based on the expectation of future dispersion of the returns on the basis of the expected volatility, the implied volatility. And the normal distribution, we all know it's very often a rough approximation of reality. Sometimes it works, sometimes it doesn't. On its own, it's not sufficient, okay, because it's wrong most of the times, not always, but most of the times. So one idea to move beyond the normal distribution could be to take into consideration the historical distribution of returns, which is, under some point of view, it's a description of the typical behavior of the asset in question. So the idea is that in looking at the historical observations in terms of the returns of this stock over some number of years should provide a better understanding of the typical behavior of the stock. In order to let you understand what we're talking about, let me show you a chart that compares directly the normal distribution with the historical distribution in reference to the stock Nike in this case. Okay, this is based on 1 year of observations and on the implied volatility of the expiration of June the 28th. Okay, as you can clearly see, the normal model, which is the orange curve, is a very rough approximation of what we could expect from the stock Nike on the basis of its typical past behavior. We could switch to a different number of years of observation, up to 5 years. And some could say the longer, the better. It usually is correct, not always, because if the idea is to try and describe the typical behavior of the asset in question, Nike in this case, in looking back 5 years from now, it means to include the COVID, which brought anything but typical. Okay, the COVID period, even if it lasted only a few months, was something completely different to anything that ever happened before. So in trying and describe the typical behavior of any asset in looking back to a time period, including the COVID, could bring a bias into our measurement. But we could avoid it, including only 4 years backward, because looking back 4 years from today means to go back to June 2020, so already 3 months after the pandemic, okay? So it could provide a better understanding of the typical behavior of Nike. And yet we can say that the normal model is quite a rough approximation of reality, because reality tells us that the typical behavior of Nike is much more concentrated on the mean than what the model suggests, meaning that the probability to stay very close to the current price of the stock is much higher than what the model suggests. And this works in favor of all the non-directional strategies, non-directional option strategies, meaning that in short selling options, both puts and calls should provide a statistical advantage in respect to what you could see in looking at the normal distribution. Anyway, the historical model brings together an advantage and a potential disadvantage, because on one hand, looking at the typical behavior of the stock on past data provides a better understanding in terms of its typical behavior. But it might happen, for instance, if, just to say, by the end of 2021, you looked back 1 year, you would have observed very positive returns on almost every asset, because the year 2021 was very positive. Okay, so depending on the specific moment and the specific time range you are looking at, in observing the typical historical behavior, you could introduce a bias depending on what happened in the time frame of observation. So we could move on and look at this problem from another perspective, and that's what Vladimir did, introducing the stress test probability. The stress test probability basically looks at the past behavior of the stock, not taking into consideration the direction of the returns. So the idea is that if someday some stock makes a plus 3%, the next day it could make a minus 3%. So the idea is that you should not look at the past historical behavior of the stock as it is, but you should take into consideration the idea that even if in the last time frame the typical behavior of the stock has been, I don't know, very positive or very negative, in the next same time frame the behavior could be the exact opposite. So if you take the historical distribution of returns and you reverse it, you have the so-called stress test probability, which basically takes into consideration what didn't happen so far, but could happen tomorrow if the behavior of the stock changed dramatically. And I can tell you, in my experience, I've been using the Platinum Trade AI over the last 6 years, more or less, almost 7 years, because I met Vladimir in June 2017, and I started using the platform right in the immediate next weeks. So it's almost 7 years I've been using the tools provided by Vladimir. And I can tell you, my motto is never fight the stress test probability, because I can tell you that, yes, no model is perfect, no model is always right. There is not a single model you should ever rely on, but I can tell you that if the stress test probability tells you, no, you shouldn't take this trade, you shouldn't take the trade, because it is very often right, the stress test probability. So the stress test probability introduces a very significant improve in the probabilistic readings of the options trading strategies. And yet it is not enough, because I told you, and I repeat, there are 10 probabilistic models within the platform. And in order to let you understand how the other works, how the other models work, I have to move on to another section of the platform, which I will explain in the next live seminar. But nevertheless, I'm going to use it in order to try and let you better understand what we're talking about. Let's take Nike, build your own, all the strikes, search. Let's pick any expiration. Let's take 1 month at least, July the 19th. You see, these are the option chains for the selected stock. Data are in real time, but here we have a very interesting time machine, which I will speak a lot about in the next live seminar. So stay tuned and follow us also the next week. We have several charts. I will show you one later when I will explain you what the earnings probability is. We have again the earnings detail report here. We have a very interesting report here, which I will show you next time, the options overview report. So far, what I'm interested in showing you is what you can make of this section here, where you have the chains. You can select any expiration quoted. You have all the strikes here, and as it happens usually in the options chains, you have the calls on the left-hand side and the puts on the right-hand side. So let's say that today I'm thinking of just to say, short selling a put on Nike. And I'm wondering what could be the right strike to sell. What could be the best compromise between maybe a lower expectation in terms of profit, but a higher probability to profit, to have that profit. Okay, so it's just a trade-off between the expected profit and the probability to keep it. So the idea could be, I don't know, what if I choose the 90 strike price and I click on the sell button and I ask the platform, am I doing it right or am I doing it wrong? What are the probabilities in favor of this trading idea? Analyze trade. And here we go. You see, we have the 10 probabilistic readings. Okay, so far I explained you the normal, the short historical, which is the historical distribution of returns over 1 year of observations, the long historical, the distribution of returns over the last 5 years, the 1 year stress test probability, the 5 year stress test probability. Okay, and as you can see, we have very different readings: 81% according to the normal, 81% according to the short historical, 69% according to the short stress test, 84 according to the long historical, 64 according to the long stress test. And remember what I told you, never fire the stress test probability. If it says 64, you'd better not take this trade. Anyway, my goal now is to explain you what are the other probabilistic readings. So it is easier for me to explain using the RSI probability. This is the RSI, this is the stochastic, this is the percentage price oscillator, this is the implied volatility and historical volatility. And they all follow basically the same philosophy, which I repeat is it's easier for me to explain looking at the RSI. 94 is not the value of the RSI. It's the probability of success with this kind of trading strategies according to the RSI. How? Let me explain. Let's take the chart of the RSI and let me explain. Okay. This is the chart of Nike over the last 6.5 years, more or less. You see January the 2nd, 2018, up to June 20, 2024, okay, today. So let me zoom to the last 1 month so that you can better see. Look at the pop-up. You see the 1, 2, 3, 4, 5, 6, 7, the 7th line states RSI 5619. That's the value of the RSI calculated with a standard measurement, okay, equal for any underlying. So there's no optimization. For every underlying, the calculation is always the same. So the current value of the RSI is 5619. We draw two horizontal lines, plus and minus 5 points. You can see down bend and up bend, 5119, 6119. So it's the current value of the RSI plus and minus 5 points. The idea is, what if looking back 6 years and something, 6 years and a half, more or less, every time the RSI was within this range, 5119, 6119, I took a trade similar to the one we are looking at now, meaning a trade having more or less 29 days expiration, okay, with a strike price at a distance similar to the one we are considering here, 90 in respect to a current price of 95. So if every time I could find a trade similar to the one I'm taking today, having the RSI between these two horizontal lines, what happened? Okay, look at this strange chart down here that looks like like a cardiac. What is the I don't know how to say that. When you go to the cardiothoracic doctor and they analyze your your heart, you have a chart like this. So every time you could find a trade similar to the one we are taking today, which ended with a profit, we have a segment, a red segment pointing to the upside. Every time you could find a trade with similar conditions to the current one, which ended up with a negative result, we have a little bar, a little red bar pointing to the downside. Okay, so after 6 years of observations, what we can do is take all this data we have here and calculate the classic definition of probability, successful cases divided by the total number of all of the cases. Okay, and that's it. That's the conversion of the RSI into a probability measure. So we could say that according to the RSI, looking back 6.5 years, in taking trades similar to the one we are taking today, we would have had a 94% of success rate. And the same could be applied to the stochastic and the percentage price oscillator, and the IV and SV, implied volatility and historical volatility. Every time that in the last 6.5 years, the volatility was between a channel around the current values, what would have been the rate of success? 86%. So this is a conversion in probability measurement of some of the most popular technical indicators, technical analysis indicators. And then we have the last one, the earning probability. What is it? Let me explain it looking at this chart. This is the chart showing the price trajectory of the expected price movement of Nike over the next month, more or less, according to two different measurements. The orange curve is an average of the distribution of returns over the last 1, 2, 3, 4, and 5 years. So this cone is the expected trajectory chart of Nike with a 90% probability over the next 20 working days, more or less. But as we all know, when there are earnings coming, the volatility gets higher, so the price could move in a more nervous way. And that's what the green curve shows us. The green curve is the conditional distribution of returns, taking into account what usually happens when Nike is going to release earnings within the next few days. So as you can see, according to the fact that Nike is going to release earnings in a few days, the expected cone of the trajectory of the price is a little bit wider than what you could expect according to just the standard distribution of returns. So this is what the earning probability refers to. What you could expect according to what the stock in question, Nike in this case, has been doing historically every time it announced earnings. So 10 different readings of the probability of success of a phenomenon. And let me repeat, because this is very important. No model is better than the others. So you should look for all the situations where all the readings are more or less the same. The higher, the better, of course. But as usual, you have to try and find the best equilibrium between having high probabilities of success and a good return as well at the same time. And basically, it's all just a problem of expectation of profit and loss. Indeed, if we go back to the earnings trade signals, you can see that aside of the probabilities, all the probability readings, we also have all the expected profit and loss readings according to all the different models. Okay, so what we have to look for is for a positive expectation in terms of profit and loss with all the probabilistic readings, because sometimes it happens that you have an overall positive expectation, but then you go inspect for the details according to the different models, and you find out that according to some models, the expectation is 0 or even negative. So that is not good. It is much better when all the readings are positive. Okay, so this is the philosophy behind the platform. And this, of course, is just a starting point. Okay, you cannot take for granted all the results, all the suggestions of the platform. You have to try and inspect in more details all the suggestions in order to try and understand whether they could be reasonable or not, whether they are okay with your risk tolerance, which is of a paramount importance, of course. And next week, I'll show you also how you can combine the information you can find here in this report that I will show you next week with the expectations provided by these probabilistic readings in order to try and improve your expectation, to better your expectations. So for now, I'm going to stop here in terms of the earnings trade signals, because I want also to show you this other very interesting section, which is the newest introduced in the trading platform. If I'm not mistaken, it's been introduced by the beginning of 2023, so it's quite recent. Options Extreme Report allows you to scan the market for very extreme events. Okay, and you can expect the markets in terms of volumes, traded volumes, open interests, and implied volatility. My favorite report is this one, the unusual individual options open interest change, which I look at every day. And I've been collecting data over the last few months and inspecting all the signals and taking some notes. In my opinion, this phenomenon could be interpreted in this way. And so I am tracking whether my expectations are correct or not. Let me also, before moving on to this report, introduce you to the site. If you didn't see it already, tradeaiplatform.com, which is both in Italian and English. In this site, you will find some videos and some pages explaining all the function of the platform. And there's also some confidential site contents. If you register to the site, you will gain access to the Monday trading preview. Every Monday, I create a video, a short video, where I present which will be the main topics of the incoming days. And there's also a service called Trading with Trade AI, in which I provide some commentaries about the best, the ones that I think could be the best trades out of all the suggestions of the platform, because the platform provides suggestions all day long. So every time you update the data, you have new suggestions to take care of, to inspect, to go into much more details and try and get a better understanding of all the phenomenon. So it takes quite a while. So my goal is, if you don't have time, or you don't want to take all the time it takes to go inspect in full details all the suggestions of the platform, this service is for you, the Trading with Trade AI. Anyway, let's go back to the platform, because it's very important for me to let you understand what is very interesting here. Unusual individual option open interest change, up or down, or both. You can pick up or down or both. You can select stocks or ETFs, and you can pick up to 50 results. Let's stay with 10, click search. And in just a few seconds, here we go. We have lots of very interesting stuff to inspect. Before moving on, let me tell you that not all the data you find here are worth of being inspected, because let me explain. Just to say, this is Apple. If you go look at the chains of Apple, you will find out that there are hundreds of thousands of options opened on almost every expiration, almost every strike listed. So knowing that we have new 7,000 new calls, strike 380 on the expiration of March the 21st, 2025 is not a big deal. 7,000 calls on Apple are nothing, okay? If it was 70,000 or 700,000, it would be different, but 7,000 is just a dot in the ocean, okay? It's just a drop in the ocean. So not all these data here are significant, but what about Carvana? Look at the first line, Carvana Co, Class A, quoting now around $108. There's a sudden, very significant interest showing on the calls 185, expiration July, in a month from now. 185 is an 80%, more or less 75% above the current price of the stock. These calls are quoting 0.11, 0.13, And these 14,283 new calls open are out of only 500 previously open. So why on earth somebody woke up today and decided, this is yesterday, of course, because the open interest is an end of day data, okay? All the other section of the platform are real time. This is end of day because the open interests are updated only at the end of the day. But why somebody yesterday woke up and out of the blue decided to purchase or to sell, who knows, 14,000 calls, 185 on the stock? Because, you know, for every open contract, the open interest is a new open contract, okay? For every open contract in the market, there are a buyer and a seller. So the question is, who is on which side? How can we try and understand this? How can we try and figure out what could be the reasons behind this peculiar movement? This is the job we have to do now, because this is just a starting point. Knowing that there are 14,000 and something new calls, it's not sufficient. We need to try and understand what could be the reasons behind this movement, who could be on which side of this movement. And you can do it. You can try and interpret, knowing what to look for and how, but it takes quite a while. You have to take your time in order to inspect all this information and try to understand. The first very important data to go inspect is whether this is an isolated peak or not, because if this was Apple, I could tell you it's useless to go inspect it, okay? It will mean nothing at all. If it's a stock on which there are 100 open contracts, usually on both call and put side, on every expiration, and suddenly 14,000 new contracts are open, it means something. Okay, it's what I call the cathedral in the desert. If you can spot a cathedral in the desert, it's a good starting point, but it's still just a starting point. You have to go much deeper into much more details in order to try and understand what could be the reasons behind. But sometimes I can tell you here, you can find the stocks that are going to multiply by 2, 3, 5 times, or you could find some very good positionings on options which you could short sell, either naked or covered. It depends on your risk tolerance level, of course. And usually I take out of these lists about 20-30% of my trading strategies, of my real trading strategy, the strategies that I put at market on my own money, on my own account, okay? Because it's very intriguing. Sometimes you can find some very interesting situations, even if it is very hard to properly interpret this information. And sometimes it happens, you make mistakes. So you have to try and do whatever you can in order to limit your risk. Most of the times I do either naked puts, and if my analysis goes wrong and I get a sign on the underlying, I take the stock and I don't know, I short sell calls against it if I can manage it. I try and find strategies to manage the assigned positions. Or sometimes I take covered calls positions. And regarding with covered calls, we will see something very intriguing next week when I will show you the call probability metrics. So stay tuned and keep following us, okay? Also next week. So that's what I wanted to show you. It's important to understand that two very important facts. The first, all the suggestions provided by the platform are always just a starting point. So you have to do your homework every time. And second, when it comes to probability, you have to look at the numbers, the big numbers. So you can't expect to take a trade having a 90% probability of success and pretend claim to be successful. Okay, what you need to do is trade a lot, because probabilities are on your favor only if you trade a significant number of option strategies. If you only take one strategy every once in a while, okay, you will never be successful. You have to trade. Okay, you have to take all the trades that look good And in the end, probabilities will be on your side. That's it. So that's what I wanted to tell you. I don't know whether there are questions, or I don't know, you're curious, you want to address questions to me, to Vladimir, or to Maxim. I don't know. Let me know. Let us know.
Okay, I don't see any comments for the moment, but as always, I think that you are pretty clear when you explain the platform.
I try to.
Yeah, even in English, I'm surprised. I mean, it's the first time that I hear you explaining.
I have quite an experience in the field because I've been teaching in English since 2005, so I'm quite used to it.
I understand. I don't know if maybe Vlad wants to add something extra to this topic, to this webinar.
Yeah, I can add a couple points beyond the details that Dominic provided for each individual stock. I would like to take a more general view on the system and explain why we came to this idea of creating this system and all this stuff. The idea, and if you watch videos, we try to explain to you. Dominic today was very particular what to do, how to analyze. But what we need to do is to understand that there is no methodology, there is no ideas that you can take and like sometimes advertise you spend 15 minutes in the market and you became a millionaire. This is I'm in this business for 30 years. I develop a lot of systems. I work with a lot of big name traders, with Larry McMillan, Sean Nottenberg, with a lot of people. And the main topic is, because you came to this seminar, probably you became professional in your field because you make money, you came as a professional people, and you understand that in order to be professional you have to learn, you have to understand you can play roulette with your money, bottom line. And the main important stuff is to learn all specific stuff, to understand the methodology behind this. And if you trust this methodology, you don't need even to go sometimes into details, the difference between normal distribution, standard deviation, all this mathematical stuff. You do not need it. What you need is you understand the idea, you trust the idea, and then you start using it, and using it. Because the main idea is, it's at the beginning, it sounds like very difficult stuff, hard to understand something, but more you get used to it, easier the system became. You better understand the system. So you have to play with this. You can't go into option trading. You have to take it and believe it. You can't go into option trading without tools, because the difference between option trading and anything else is option trading is more or less is math game. Because in stock, you can buy stock in anticipation that it will go down because of some fundamentals, if you can analyze this. In options, the beauty of the option trading that you can create option trade, then even stock goes against you, you're still making money. So that's all in options. It's all probability game. And as Dominic mentioned to you, there is no one model that describe all these complications of the trading. I mean, you can compare trading with a casino, for example, and say why, if casino is profitable, I should be profitable. But the only difference between probability trading in options and casino trading, for example, is when you go to casino owners set up a slot machine, for example, for certain probability, for certain distribution and expected profit loss. And more you play, more you lose money, because that's statistics. In option trading, you do not know, you cannot trust normal distribution that most of the traders use. So, because it's like Dominic shows, and it's in some cases, it's absolutely different from the normal distribution, the real historical, for example, distribution. So that's the reason for sometimes you hear, oh, I was using probability trading, but I was losing money. The idea is that all models that exist right now is calculating probability based on normal distribution, everybody. So if you take something wrong at the beginning, you get a result wrong. So that's why we came to these models that will give you multi-pronged approach to trading, and you can look on your trade from different angles, and then you can create a right expectation of the coming results. That's pretty much simple stuff that I would like to explain.
Thank you very much, Vladimir. I see that we have one question. Maybe you want to answer, Domenico. The question is, does the Trade AI platform work also for day or weekly trading of stocks instead of option trading?
Does this platform also work for day, week trading of stocks, or is more for? Okay, the platform is both for options strategies, stock strategies, and ETF strategies. Indeed, there are 6 sections dedicated to option trading and 3 sections, stock analyzer, stock trading ideas, and portfolio builder, which are more focused on stocks and ETFs, using the same philosophy. So using the same probabilistic models, but applied to stock strategies and ETF strategies. So you can have all the 3.
Okay, and Matteo, that also participated to the Italian webinar, is asking if can we say that this platform is more oriented to short-term trades, like 1 month or less. Longer time means more events that can affect the expected probability. I don't know.
It's correct. It's correct. The shorter the time, the more reliable the probabilistic readings are. Almost because the longer the time period, the more unexpected events could come into play and affect the results.
Okay, okay.
And one more add to these ideas, like Dominic said, probability does not mean guarantee. Probabilities start working only when you have a lot of trades, when it became statistics, when it's not walk into casino, play 1 time, get jackpot and walk away. Yes, you winner. But if you play for a lot of time, you will lose money. That's the idea of casino. But in our case, you became like owner of casino. You play against everybody else as an owner of casino based on probability. That's why you have to do more trading in order to achieve proper result. And that's why more short term is more advisable.
Okay.
Fantastic. I think there's no more questions for the moment, but if you see the recording videos in the next days, you can always write to your email, Domenico, right? What is the email address they can write?
It's info at sorry, info@tradeaiplatform.com.
Fantastic. So if you have any questions, you can write to this email address. Otherwise, you can send an email to Maxim. We will, of course, send you the recording videos. You will find it also in our YouTube channel. And you will receive also the next invitation for the next webinar, the second part. What else we have to add? There is a big discount for Maxim clients that wants to join the Trade AI platforms. So if you want to know more about it, just send us an email, and we will, of course, provide you all the informations. For the moment, I just want to say thank you, Vladimir, to participate, and thank you very much, Domenico, for the wonderful explanation.
Thank you all.